So, all right, so how many of you are here in the morning for Anand Sanwal's talk? Okay, so Anand talked about data. I'm the opposite of data, okay? So a lot of what I'm going to talk to you about today is actually just based on observations that I have seen over the past maybe 3 years, and just kind of my analysis of what is happening in the venture space, okay? And I'm not going to talk about who I am in K9 Ventures and stuff. All that stuff is on the web, and you guys know how to use the web. Okay. Okay, so the topic of my talk is effectively seed is the new A, and I'm going to talk about what the implications of that are. One other quick note about format. I actually like taking questions interactively. Okay. I would much rather have this be a conversation as opposed to you guys asking me questions at the tail end. We'll have to manage time together, but please feel free to ask me questions while I'm talking. Okay. Okay, so first, I thought I'd start with this, that venture capital may very well fund a technology revolution, but it itself evolves very slowly over time, right? And this is not something new, it's something that we've all recognized. And I think it's important for us to sometimes take a step back and actually think about when something has changed. And I think right now is one of those times. So I'm going to actually take you back to June of 2013. This was my first LP meeting for K9 Ventures 2, which is a $40 million fund. And I was kind of thinking about, okay, what am I going to really say to my LPs? And here's some of the stuff that I said to them. Okay. And I'm going to, the slides for this are actually available on SlideShare. So if you want to read the fine print on them, you can read it there. But just to summarize, one of the first things I said to them is that there is no Series A crunch. Okay? And the Series A crunch is actually a function of there being too much money at the seed stage. Okay? And what that means is that the Series A investors could now be a lot more picky about what they want to invest in. And therefore, their bar for what it means to actually get to a Series A has gone up. But it's not a function of less deals happening at Series A. It's a function of more deals happening at the seed stage. Okay. Second, around the same time, we began to see massive late-stage rounds. And I describe this almost as a flight to traction, where the big funds essentially decided that they want to invest in companies that have traction. There aren't a lot of companies who kind of get to that massive traction, and so they're all trying to pile money into these companies. There was a lot more competition for Series A because of there being more seed companies. And the implication of this was that since the bar for the Series A went up, it means that the seed stage companies need more traction, which means they now need to run longer in order to get to that level of traction. At the same time, what it costs to actually run a company went up dramatically, especially in the Bay Area, right? In 2011 and 12, I used to do my back-of-the-envelope calculation on the basis of $100,000 fully loaded per person per year. Okay? In 2013, I started doing that at 150, and I was being told that that is way too low. Okay? So just the cost of recruiting and the increased competition for recruiting meant that companies need to have a lot more capital in order to get there. And all of this is kind of what resulted in the seed stage kind of ballooning up. So at that time, in 2013, I introduced the term pre-seed. This was almost kind of as a joke, because I wanted to make the point to my LPs that I'm not a seed stage investor anymore, right? That I want to be the first institutional money into the company, and that might actually be even before seed. Okay? And the Series A was really the fourth round of funding for a company. And it's the fourth round of funding for a company because first you may have friends and family, or 3 Fs, that's friends, family, and fools. Okay? And then you may have incubators at the same stage. Then you'll probably have a pre-seed round, then you'll have a seed round, and then you'll get to Series A. Okay? So this is all the stuff that I was talking about in 2013. And another big thing to think about there was all the people who were writing 25, 50, 100K checks, those were the super angels. They became micro VCs. And I'm very much one of those people where I started out writing $100,000 into a company, and now I'm writing about a $500,000 check. Okay? So the super angels are micro VCs. Seed is the new Series A. and the Series A is the new Series B. And in fact, I think around the same time, Jeff Jordan from Andreessen Horowitz had a blog post on TechCrunch, which talked about Series A being the new Series B. Okay, so let's come back to today. Okay, so what's happening today and what's the situation like now? Well, seed is the new A. And I say that very emphatically now because that is almost how all the seed stage deals are happening. The round sizes of balloon to be almost above 2 million. The valuations are rising to match. You're now looking at seed rounds, which are happening. If investors are lucky, then it's like a 6 million pre. Otherwise, more likely, it's like an 8 million pre raising two. The expectations that GPs have for the seed stage companies have also changed. And that's probably one of the biggest points here, and I'll come back to this in a little bit. They're now looking for traction. They're looking for revenue models. They're looking for unit economics. Okay? And this is a logical evolution of how a venture fund will grow. Okay? So, and I have a blog post called The Venture Spiral in which I talk about this more, that essentially the only way for a fund to grow is to increase the assets under management, increase the number of partners. Right? And if you do that, then without fail, you will end up kind of spiraling up into larger round sizes. So Sharon tweeted this just yesterday, and I saw this tweet and I had to laugh. $3.5 million seed round, and it's referred to as a mango seed. Okay. Pre-seed is the new seed. So what's happened is that if the companies don't have the traction to raise a seed round, what are they going to do? They're going to have to raise less money, and that round is typically around $500,000, and it is used for building the team and the product. And I'll also say that there are very few funds that are actually doing pre-seed investing. And so in a way, I kind of see the same gap that emerged in 2009, 2010, which led to the formation of all these seed funds. I see a very similar gap emerging today, mostly around the pre-seed stage. So what are the implications of this? And I'm going to talk about this as implications for founders, for GPs, and for LPs. So for founders first, raising a seed round is harder. Deal with it. That's the new reality. The good news is there's lots of capital and there's lots of new funds. The bad news is there's a massive change in expectations of these funds. Okay. Seed is not the first round, and this is really something where founders' expectations are off. They see stuff in the press saying that, oh, this company raised $2 million, this company raised $3 million in their seed round, but they don't realize that these companies are much further along and typically have more traction than what they might have right now. So they themselves expect to raise $2 million off the bat. So my advice here, and somewhat self-serving, is raise pre-seed first and then grow into a seed round. So I went to Carnegie Mellon, so Andrew Carnegie has a special place for me. And one of his quotes is, "As I grow older, I pay less attention to what men say, I just watch what they do." And I say exactly the same thing to founders. Watch what investors do, not what they say. Okay? Investors are not clear in their messaging. And founders really need to look at who they've funded, how much money they've invested, and at what stage that funding happened. Okay? And by looking at these three things, and it's a very noisy environment, so it's not easy to actually extract this signal, but looking at this is better than actually reading funds' websites. For GPs, stop living in denial, right? If you've spiraled up, if you're essentially managing more capital and you've moved upstream, then you need to realize that that has happened as well. It's a natural evolution, and it's not always a bad thing. But the one thing that they do need to do is that they do need to revisit their messaging. Okay. For LPs, lots of implications here for LPs. Your early stage investment portfolio may no longer be early stage. This is especially true if you've been invested in traditional venture capital on Sand Hill Road. That's not early stage funding anymore, right? So the traditional VC firms all moved up the spiral, and that means that the return profile that the traditional VC firms will have will also change. And I don't mean that like a particular firm will have a bad return. There will still be certain firms that will have great returns. But across the entire industry of traditional venture capital, the returns will change to reflect the fact that these firms have moved up the spiral. Pre-seed and seed funds are likely to have the outsized returns because they are the ones who are getting in earlier. That's, the earlier you get in, the better the chance of the multiple that you're going to have. For LPs, micro VCs are the new Series A investors. And that's also something that they need to realize. A lot of LPs have already invested in micro VC funds. Some haven't. And I would actually say that those who haven't may have already missed the boat on some of the best funds. There will be a new crop of pre-seed funds emerging. And I actually feel that there's a dearth of funds at this stage right now. But if I'm an LP, I would not want to be in your shoes because it's really, really hard to pick which funds at this stage are actually going to do well. This is probably one of my biggest points for LPs. Scaling venture capital breaks it. Venture capital is a boutique industry, in my opinion, and it needs to remain a boutique industry. What that means is that if you find that venture capital is actually giving you good returns, and you turn up the knob on how much money you're putting into venture capital, the returns will not scale linearly. They will actually decline over time, right? And so I actually blame LPs for the bad returns that the venture capital industry has, because every time the venture capital returns start to get good, they put more money into it. When they put more money into it, the returns are going to go down. Okay? The management fee and carry structure that most funds have gives the funds an incentive to increase the fund size. That's just, again, another reality of how things work. And it's something that the LPs recognize, and they already kind of know this. Okay. There's way too much capital coming into venture capital right now. A lot of this money is actually coming in from non-traditional sources. And by non-traditional sources, a lot of it is actually coming from non-traditional geographies. It's China, it's Russia, it's Middle East, and it's India. And I'll give you a quick anecdote. I had at least one person come and tell me that, hey, I can raise a big pile of money for you from India because there are a lot of people there who want to go to cocktail parties and say they've invested in tech companies in Silicon Valley. Okay. And knowing the culture, I can totally believe that. Okay. And a lot of this new capital has led to the formation of lots of new funds. Another place where there's too much capital coming from is from Wall Street. And the realization on Wall Street is that they cannot wait for companies to go public anymore. So Mark Schuster did a blog post, and in fact, he gave the talk here at PreMoney last year, where he talked about how the value creation predominantly is happening in private markets and not in public markets, right? Wall Street recognizes this as well, and they've realized that they need to come in and get stakes in these companies while they're still private, because otherwise they're not going to see the upside in these companies. So there's hedge funds coming in at late stages, there's banks coming in at late stages, and some things that I don't understand is why is Wall Street being so insensitive to valuations? Okay. And a lot of the thinking around this is that is it liquidation preferences that are dominating their thinking, that they feel that at the least they will get their money back, right? And if that's the case, then they're not really valuing the companies based on what they should be valued at, and that's kind of why we see the inflation in valuation. Another source of too much capital is corporate investors, right? And I'm no expert on macroeconomics, but we have an environment where there's really, really low interest rates. Big companies and big corporations are sitting on a lot of cash, and they don't know what to do with this cash. And so what they do is they actually end up investing it into private companies. And for a lot of these corporate investors, they're treating it as a money management strategy. For them, they simply don't want to lose money. If they make money, that's just the icing on the cake. And I'm going to claim that there's an erosion of valuation discipline across all stages of venture capital right now. It's all the way from seed to Series A, to Series B, to late stage. In every single stage, the valuation discipline is essentially lacking or broken. Mark Andreessen tweeted this a few days ago, and I looked at this and I had only one reaction to this, is that this is a hell of a run that we've had for the past 7 years. So Dave likes to ask the question, and he's been asking the question today about bubbles. And so I figured I can't give a talk without addressing his question about bubbles. Turns out I'm an expert in bubbles. Okay. But I'm an expert in bubbles of the soapy kind, not the economic kind. Okay. And so this is a video of my daughter, and she's actually making some really, really big bubbles. And this is one of the videos where she actually got the bubble to close all the way around. My son also likes to get into the action, and he's also making bubbles. Okay. And the one thing I'll say about bubbles is bubbles are awesome. They're so much fun to play with. They're fun to watch, but ultimately they pop. Okay. And with that, I'll end, and I'm happy to take any questions. And if you want to actually get the details on what I said in this talk, I'd encourage you to go and look at the blog post, because I go into a lot more detail over there. Thank you, and I'm happy to take questions.
You had mentioned that super angels are moving into micro VC, but you hadn't mentioned angels. They're certainly not moving up to super angels. What's their role in this new investment thesis?
That's a very good question, and I haven't actually thought about it beforehand, so I'm going to give you an answer on the fly. I think effectively, and I actually did a blog post in which I described like the venture capital nomenclature. And my definition of an angel is somebody who's investing their own money, but doing it as a hobby. They're not doing it full time, right? And my definition of a super angel was somebody who's investing their own money, but doing it full time, right? And so the people who were doing it full time, they were obviously, they want to turn this into a business. So they're the ones who've essentially become micro VCs, and my definition of a micro VC is somebody who's managing like if you're managing other people's money, you're a VC, you're not an angel anymore, right? So I think the super angels kind of moved up to the micro VC stage. I think a lot of the angels may also, like if they end up becoming super angels and micro VCs thereafter, but a lot of people may just be content just investing on the side and still have a full-time job. So, other questions? Paul? There's a mic coming to you. Yeah, go ahead.
Perfect. Do you think the market moved? Couldn't agree with you more, by the way. Great job presenting it. But do you think the market moved because we were following the mechanics of a startup, right? In 1999, when we did startups, the first thing we did with the big pile of money was rent a cage and start buying pizza boxes and stacking them up in there, right? And we no longer have to do that, so we can get a lot more traction faster and with less money. And is all the rest of this chaos just the market responding to that reality?
I'm gonna answer with I don't think so, but I don't have a more nuanced response for you yet. I'll think about it more. Okay. Yes. There's a mic coming to you as well.
Okay, very interesting. Where in your system is the syndicates? Like, I mean, this morning we talked about page was syndication. So where it sits in your system?
So actually, in the blog post, one of the other points I make is that there is a lot of interest and attention on tech companies. It's almost like you can take politics, Hollywood, sport, and tech companies, right? It's like they're all almost up at the same level. So there are people all over the world who feel like everybody should be investing in tech companies. In fact, one of the questions I was asking Dave and Naval about is, I'm curious to see how much international money is coming in through AngelList, right? And likewise, when you ask about syndicates, I think there's a lot of, I would describe it as almost retail investors who want to actually get into technology investing, but access to technology investing is very limited. But that's the whole flood of money that is kind of being attracted towards early stage investing. And in the blog post, I also mentioned that if and when this bubble pops, all of this capital is going to evaporate like this. It'll be gone overnight, right? And whether it's the corporate money or the retail investor money, all of that will disappear overnight if there is a correction. Okay. Who has the mic? Go ahead.
You mentioned that valuations for seed round now is 2 million at 6 to 8 million. What are the pre-seed valuations?
Definitely lower. I don't have any, so like I don't give any metrics out because like any numbers out like that, because then it's like, oh, this is what you said over here, this is what the valuation should be. I'll actually use Paige's line there that when I'm negotiating a deal, I'm driving for the lowest valuation possible. So. Last question. So, go ahead. I have absolutely no idea. As I said, I'm an expert in soap bubbles. Okay. I have absolutely no idea what will cause it to happen, but it could be anything. I have no idea. So.